Hey family, welcome back. As you know, I'm financial coach Lennox Jeffrey, and in today's video, we're actually going to go over the difference between whole versus term life insurance so that you can determine which is actually better for you and your family based on your overall financial goals and dreams, right? Okay, so let's get started. All right, so whole life insurance. Whole life insurance is something that most people actually have, as well. A lot of companies get people to get, right? So let's go over it exactly. So whole life insurance covers you for your whole life. Your whole life is considered age 100, right? As a whole life. So how it works is usually it's a two-part account where they give you an insurance and they give you a savings, right? You pay $100 a month for it. It's a typical policy, and you get $100,000 of coverage, which covers you for your whole life. And you make payments of $100 every month until age 100. This is a basic whole life insurance policy because there's other whole lives as well, right? It typically grows at a guaranteed 4% interest. So most people like this because you have a death benefit, you're paying $100 a month, and it's a built-in savings where they tell you in 20 years you will have a cash value, a savings of $20,000 that you can borrow against, you can give to your kids for college. So these are your typical average whole life insurance policies. All right. So here's some things that most people don't know about the whole life policy. For one, there's zero money saved in it for the first 2 to 5 years. Zero money. Imagine having a bank and you put $100 into an account for the first two to 5 years. Let's say 2 years. That's 24 months. So you should have $2,400 sitting in that account waiting for you. If you go to take it and they tell you there's no money in that account, wouldn't that be a problem? Yeah, and most people use this to use actually as a savings vehicle, right? The second thing, let me go back. So the reason why that happens is because they use that money to pay the agents and to cover administrative costs. That's why the money takes some time to build up. Okay, the second thing is you have to borrow your own money. Now, I always ask, if you have to borrow your money, is it yours? It really is your money, but it's not. Not only do you have to borrow your own money, you have to pay it back at 6 to 8% interest rate when it was only growing at a 4% interest rate in the first place, right? Now, the third thing is you have $100,000 in your death benefit that you've been paying $100 into every month, right, for your life. And you have $20,000 saved in your cash value for your policy, right, that you can borrow against. If something were to happen to you, shouldn't your family get the whole $120,000? Of course they should. They should get everything. Logically, that makes sense. Here's the thing. They're not going to pay your family the whole $120,000. What they're going to do is they're going to pay your family the $100,000, and guess what they do with the $20,000? As you see on the board, the company keeps your cash value at death. Why are they able to do that? Yes, they'll keep the whole $20,000 in this case. Why? Because when you allow them to attach the insurance and the savings together, then you only get one or the other. You do not get both. You do not get both when it comes to basic whole life insurance. So your family will get the $100,000, and the company will keep all of the money in your savings in this policy here. All right. So here, let's talk about term insurance. So term insurance, you could get a 1 year, 5 year term, but usually you typically get like a 20 to 30 year term policy, right? What I've learned is really important, as you saw in the previous example, not to attach the insurance and the savings together. You must separate the insurance and the savings from each other, right? So the average, so you have the insurance here and the savings here. So the average 30-year-old, just to give you an example, can qualify because you cannot buy life insurance. You have to qualify for it. So the average 30-year-old can qualify for $300,000, 30 years, and pay under $50 a month for it. That's a big deal when I learned that, right? And the reason why you're able to do that is because with term insurance, there is no savings to it. It is purely a death benefit. If something happens to you, that money goes to your family as your beneficiaries, the people that you're leaving behind, to replace your income that you lost so you don't lose the things that you worked hard for, right? So they get that whole $300,000 and you don't pay any taxes on it. Okay, so now what I say is if you're going to set up a term policy, this is where a lot of people run into problems with. They say, okay, in 30 years, what happens if I have a policy for 30 years and then at the end of it, it runs out? Then what? I put all that money in and there's nothing there. If you really do the math on that, $50 going into for the year is actually $600. $600 times the 30 years would actually be $18,000. So at any point when you had that policy, your family would have received the $300,000, and you only paid less. You paid less than $18,000 over the life of that 30-year policy, right? Okay, so what I've learned is it's really important if you're going to do a term insurance policy. Yes, you can get the coverage, whatever, and it protects your stuff, but you have to set up a mutual fund, an investment alongside that. Whereas you take the other $50 where we're comparing 100 in the other example versus what we're doing here, 100 versus 100, put the other $50 into a mutual fund. Now, mutual funds has averaged 10% interest over a 20-year period. Sometimes it's down, sometimes it's up, but overall it's averaged 10% interest over a 20-year period, right? Why is that important? Because the interest rate determines how fast your money doubles. So just comparing the 20-year period versus the 20-year period in the other illustration, this would be approximately $40,000 with that $50,000 going in there in that 20-year period. Right? That's a big deal. So if something happened to your family within that 20 years, comparing apples to apples from the previous example, your family would have gotten the $300,000 for the life insurance plus the $40,000. So that's $340,000. That's a big deal. But here's the thing. If you lived past the 30 years, right, the kids are grown at that point, the mortgage is paid off, and you're out of debt. So it's less of a need for insurance, and it's more of a need for you to have money saved for you to live on at that point. So at that point, this was able to grow more because you could put more into that account, and you can have your mortgages paid off. You can have your 401k or 403b through the job. You have other investments, multiple streams of income coming in. So it's less of a need for insurance, more of a need to have money to live on, and all of that get passed down to your family. So here's the difference between whole life versus term. As I explained, whole life covers you for your whole life, but you really don't need insurance for your whole life. You just need it for a period of time when the loss of an income would be most devastating to your family. Because if something happens to you and you have a mortgage and you have young children, where is that income going to come from to replace your income? This is why it's not taxable, because it's really considered replacing a loss over just for burial. All right, so I'm financial coach Lennox Jeffrey. I hope this video was helpful for you, because a lot of people are talking about, is whole life better, is term better? Overall, if you have a young family, if you have a mortgage, if you have people depending on your income, and you have a tight budget, especially for middle income families or people that don't have much money, your best bet is to go with a term insurance and invest the difference, because you get more value and that money's not taxable, and you can start building up for your future overall. All right, so I'm financial coach Lennox Jeffrey, and I thank you for watching this video. Like, comment, share, leave your comments below. I'm interested in seeing your feedback, and I'll talk to you soon. All right, have a good one.